Every now and then, our economy behaves in really weird ways. Like that time, the price of oil went negative, or when one small hedge fund almost collapsed our entire financial system, or when the existence of one type of contract triggered a $182 billion bailout to one company. These events seem random and strange, almost like glitches in our economic system. And these events also seem completely unrelated. Different years, different markets, different causes, different consequences. But they all have one thing in common: derivatives. A shadowy layer that's looming over our entire financial system. Warren Buffett has called them financial weapons of mass destruction. And once you understand what they are, you start to see just how fragile the entire system really is. But let's start at the beginning. Our financial system has layers. The more at the bottom the layer is, the safer it is. And the further up you go, the riskier it gets. At the very bottom, you have things that have always universally symbolized value. Historically, that is gold. Real stuff. You can touch it, it doesn't vanish, and people have wanted it and traded with it for thousands of years. Above that sits cash, paper money. Eventually, people got sick of carrying around their money in gold, and the first banknotes in Europe were printed around the 1600s. The Chinese were, of course, way ahead of us and had already started circulating banknotes around the 7th century. Also, real quick, most of what we call money today isn't actually cash, it's deposits. The number you see in your bank account. That number is not a pile of cash sitting in a vault somewhere. It's a liability the bank owes you. Banks create deposits when they issue loans, which already makes our system more fragile than it looks. But that's another story. Let me know if you want a video where I explain how banks create money. Anyways, the next layer is government bonds, which basically are just IOUs from governments. If a government needs money and doesn't want to raise taxes, it will issue bonds. So whoever buys these effectively lends that government money. Because governments are usually pretty stable, these tend to be some of the safest assets. And obviously, if a government is perceived more stable, the bonds they issue are perceived as less risky. And yeah, I know, if you keep up with politics these days, it might not seem like governments are that stable. But they are once you compare them to companies, which are usually way more likely to go bankrupt than a government. Which is why stocks of a private business or real estate are seen as riskier than government bonds. Businesses are more likely than governments to go bankrupt, and houses are more likely to collapse than the government. So this layer is riskier. But stocks and real estate are still tied to the real economy. These stocks are tied to companies making things, people working, and houses are standing around, being lived in, rent is being paid for them. Now we move into the more fragile part of the pyramid. Securitized debt, package mortgages, and all the things that blew the economy up in 2008. You might have heard of collateralized debt obligations, CDOs. A CDO is what happens when you take a pile of loans, bundle them together, and sell different slices of that bundle as separate investments. But here's the important part. These CDOs didn't blow up the economy on their own. They brought the economy to collapse because they were combined with what sits at the very top of this pyramid: derivatives. And to get a grasp on just how extreme this top layer is, let's look at the scale of everything. To illustrate, all of the gold in the world combined is worth about 13 to 15 trillion US dollars. Cash is about 89 trillion in physical cash and over $150 trillion in raw money, which includes cash and bank deposits. The total value of all stocks globally fluctuates, but was estimated to be around 123 to 127 trillion in late 2025. And the total value of real estate in the world was approximately 390 trillion as of early 2025. And all derivatives combined are roughly estimated to have a notional value of $846 trillion. Derivatives are enormous, and the impact they can have on our economy is very, very real. Okay, but now back to our actual question. What even are derivatives? A derivative is basically a contract whose value depends on something else. It functions as a sort of bet on the price movement of something else. That something else is called the underlying asset. It can be anything, like a stock, a barrel of oil, an interest rate, a currency, or it can also be totally random stuff, like the weather or wheat. How valuable this contract is derives entirely from the development of the underlying asset. If the underlying price moves, the derivative also moves. In what direction depends on the type of contract. But why do they even exist? Derivatives were in fact created for a very normal, very reasonable purpose: hedging risk. Like farmers trying to protect themselves from price swings, or airlines who are terrified of oil becoming more expensive, companies trading internationally and needing protection from exchange rate movements. But derivatives aren't just used for protection. People quickly realized they can also be used for speculation, often on a massive scale. A scale where one misplaced bet can erase billions, collapse a bank, or ruin the lives of people who had nothing to do with the bet. But before we get into all of the juicy stuff, we have to understand how derivatives work, because there are different kinds and they all operate in different ways. So in this video, we'll look at the most common ones: futures, options, and swaps. So let's start with the first type of derivative: futures. A future is basically a contract where two parties agree to buy or sell something at a fixed price, but in the future. Hence the incredibly imaginative name. Originally, futures were used for stability and safety. Here's an example. This farmer already knows that the rent for his farm will be due in 3 months, and it will be $25,000. He also knows that he will roughly produce 5,000 bushels of wheat. If he sells them all for $5 a bushel each, he has enough money to cover rent. But if the price of wheat falls, he is kind of fucked. He would be a lot more chill if he could just lock in the price of crops in advance. Luckily, this baker has a similar issue. He also wants to have stability of the price of wheat in advance, so he can plan better. Because he too has to pay rent and all sorts of other stuff like his internet bill, his daughter's ever-expanding Warhammer collection. If that Warhammer collection growth slowed down, family dinners would be a lot less pleasant. So what do? They both go to a futures exchange. Basically, a giant marketplace where these contracts are standardized and ready to go. And there it is, the perfect solution. A futures contract that says the baker will buy 5,000 bushels of wheat from the farmer in 3 months at a fixed price of $5 per bushel. So a total of $25,000. Boom, done. The farmer locks in the price he needs. The baker locks in the cost he wants. And no matter what happens to wheat prices in the real world, hurricanes, droughts, crazy TikTok trends involving wheat, both of them now have stability and have peace of mind. Also, the date in the future when the sale is actually happening is called the maturity date, just in case you want to learn some fancy finance lingo. When the time comes, so when the contract reaches maturity, the contract forces both sides to honour the deal. And this is essentially what hedging is, using a derivative to eliminate uncertainty. Although you can also hedge without using derivatives, but that's another story. Anyways, originally, this is why futures were invented. They were designed to protect people in the real economy from unpredictability. But of course, it didn't stay that innocent. Now we're entering the fun, unhinged part of futures, where the farmer and the baker walk out of the story and the psychopaths with Bloomberg terminals walk in. These guys don't actually want 5,000 bushels of wheat delivered to their flat in central London in 3 months. Where would they even store it? Their bathtub? But to understand why the speculators come, we first need to see the baker and the farmer one last time. Because there's one more element we haven't talked about yet. The value of this futures contract. At the start of our story, this is just a piece of paper. But as soon as the farmer and the baker sign this contract at $5 per bushel, the contract itself now has a value. A value that constantly changes as the real price of wheat moves. If the real price of wheat rises to $8, this contract becomes really valuable to the baker. He can now buy wheat for $3 less than everyone else in the market. But if the price of wheat falls to $3 per bushel, the contract becomes really valuable to the farmer because he is now able to sell his wheat for $2 more than all the other farmers. Basically, what's important to understand is when the wheat price moves, which is constantly, the value of the futures contract moves too. And also, the farmer and the baker don't actually have to wait 3 months. If one of them changes their mind, they can just sell the futures contract to someone else at its new market price. And this is where the speculators come in. Because once people realized you could buy and sell these contracts without ever touching the wheat, a very different type of character entered the game. And what they want is something entirely different than stability. They want price movement, aka volatility. Because if the value of the wheat changes, even by a little, the value of the future contract changes too. What's also important to realize here is that futures contracts on exchanges are standardized. And for wheat, one futures contract is always for 5,000 bushels. And that means even tiny price changes suddenly become big money. If the wheat bushel moves by just 10 cents, this happens. 10 cents times 5,000 bushels equals $500. And these guys on Bloomberg terminals, they don't just buy one futures contract. Large hedge funds buy several thousand futures contracts at once. And not just wheat futures, futures on all kinds of stuff, from frozen concentrated orange juice to stocks and exchange rates futures, everything. And it's not just hedge funds. Banks trade futures too. In fact, some of the biggest disasters in financial history come from exactly this setup. Before we keep going, I want to talk about maths really quick. Because as you can see, to actually understand the impact of derivatives, you can't just memorize definitions. You need to be comfortable reasoning intuitively and thinking about scale, rates, and how small price changes can turn into very large outcomes. That's why I like practicing my math skills with Brilliant. Brilliant helps you develop that kind of mathematical intuition through active problem solving. Also, I'm sure that because you clicked on this video, you are probably already kind of interested in maths or have other nerdy tendencies like I do. But if you're in the same boat as me, maybe it'll be useful to you too. Because when I finished uni, I kind of stopped regularly practicing maths, and that kind of made my math skills really rusty, and to be honest, I got kind of bad at it. Brilliant helped me get that fluid mathematical intuition back by setting me up with a personalised learning plan and helping me practice with visual and interactive problems. Oh, and Brilliant doesn't just help you with maths. There's also loads of courses from computer science, scientific thinking, and data analysis. So if you want to sharpen the kind of quantitative thinking that this video relies on, you can try Brilliant for free for a full 30 days if you use my link, brilliant.org/AnnaBocker, or you can just scan the QR code on the screen and I'll also link it in the description. Also, Brilliant is offering 20% off an annual premium subscription to my viewers, which gives you unlimited daily access to everything on Brilliant. So thank you, Brilliant, for sponsoring this video, and now let's get back into it. In 1998, a hedge fund called Long-Term Capital Management had built up enormous, highly leveraged positions in futures and other derivatives. These positions were spread across almost every major bank, meaning these banks were literally on the other side of LTCM's trades. If LTCM was the farmer, the banks were the baker. But LTCM also borrowed absurd amounts of money from these same banks. So the banks weren't just the counterparties, they were also the lenders. So one day, when markets moved the wrong way, LTCM's losses spiraled so fast that the US Federal Reserve had to step in and organize a rescue. Because if LTCM defaulted on the derivatives and collapsed, it would default on the loans, meaning the banks would have lost huge amounts of money, which would have led to a cascading failing mechanism that would basically have taken the entire financial system down with it. And as wild as that sounds, we're still nowhere near the edge, because the futures market has a whole other level of weird, and things are about to get even stranger. In April 2020, something happened in the futures market that should have been impossible. Oil prices went negative, as in people were paying to have oil taken off their hands. So how does something like that even happen? Let's break it down. Oil futures work just like the wheat example. And here's the important part. If you're still holding a future when it expires, you have to take physical delivery of the oil. It's like when the trader in the central London flat would have to store all the wheat bushels in his bathtub. Except instead of 5,000 bushels of wheat, you're dealing with 1,000 barrels of crude oil per contract. Try storing that in your bathtub. Usually, an oil future expiring never becomes a problem because refiners want oil, airlines want oil, and industrial buyers want oil. But in April 2020, the world didn't want oil. An infamous virus was grazing over the world, forcing everyone into lockdown. Planes were grounded, cars weren't moving, factories were shut, and storage tanks were full. No one needed oil, and there was, quite frankly, no storage space left for it. So as the May 2020 oil futures contract approached expiration, so-called maturity, the speculators, the guys who never intended to touch a single barrel of oil, suddenly realized, oh god, if nobody buys this contract from me, I'm actually going to receive 1,000 barrels of crude oil in 2 days, and I can definitely not keep it in my bathtub. So all these speculators panicked at the same time and tried to sell their contracts. But there were no buyers because everyone already had too much oil. And when everyone tries to sell and nobody wants to buy, and people really don't want to use their bathtubs as storage space, the price doesn't just fall, it goes negative. The price of the May oil futures contract dropped to minus $37.63, meaning traders were literally paying someone $37 per barrel to take the obligation off their hands. It was pure chaos. A global commodity, one of the most important in the world, was trading below zero because how futures contracts are structured. And that's the point. Futures don't just reflect reality. Sometimes they create their own, much weirder reality. A reality where one hedge fund run by a couple of people who, in the case of LTCM, were Nobel Prize winners, can take down the entire global financial system. Or where one of the most important commodities in the world has a negative value. And that's just one kind of derivative. Let's get into another one. Options. But before we get into options, just one final note on futures. You might have also heard of forwards. They're basically the same thing as futures. Two parties agreeing today on a price for something that will be traded at a future date. The difference is that futures are standardized and traded on exchanges. So one wheat futures contract is always for 5,000 bushels of wheat, and an oil futures contract is always for 1,000 barrels of oil. But if you only want to trade 50 bushels of wheat, you can't use a standardized futures contract. You'd have to make that agreement yourself. That will be a forward. Forwards are customized and traded privately between two parties. And because they're not traded on exchanges, they're said to trade OTC, which means over the counter. Okay, so now let's talk about options, another major type of derivative. If futures are like making a firm promise you will buy or sell, options are more of a I might want to buy or sell this, but only if it benefits me. An option contract is a contract that gives you the right, but not the obligation, to buy or sell something at a specific price sometime in the future. That last part, not the obligation, is what makes options so flexible and also tempting for speculators. Because as you saw with the oil, it is just massively inconvenient to be forced to buy 1,000 barrels of oil. and also it's quite expensive. Options are way cheaper. The amount you can lose is limited, while they have an unlimited upside. So options basically let people take large asymmetric bets with little money, and that changes market behavior. Why does it change market behavior? With futures, taking a position is risky and can be really expensive. You can lose a lot of money very quickly. And if things go wrong, you're forced to keep paying up or get wiped out. That naturally limits who plays and how aggressively. Options remove a lot of that friction. They're cheap upfront. Your losses are capped, and you can control very large positions with very little money. That means many more people and institutions are willing to take extreme bets. But before we get into how options change the market, I should probably first explain how they actually work. With futures, both sides of the contract are locked in. At maturity, the trade happens no matter what. One side must sell, the other side must buy. Options look similar at first. They're also contracts between two parties. They also specify a price, the so-called strike price, and a future date, maturity. But here's the crucial difference. Options have an escape door, but only for one side. At maturity, one side gets to decide whether the trade actually happens. They can go through with it, or they can walk away. Let's have another look at our baker and farmer. With the futures contract, the farmer had to sell and the baker had to buy at maturity. Even if the price of wheat bushels had gone up to $100 per wheat bushel, the farmer would still have to sell his wheat bushels to the baker for $5, which obviously is kind of frustrating for the farmer, as all his farmer friends now get to sell their wheat at $100, and only he has to sell his wheat at $5. But if instead of a futures contract, they had signed an options contract, more specifically a put option, there would be an escape door for the seller, which in this case is the farmer. So with an options contract, he could basically just say, oh, never mind, I don't want to sell my wheat bushels to you, but if the price of wheat had sunk to $3 per bushel, the farmer will obviously choose to go through with the contract and sell his wheat to the farmer at the agreed $5. What the farmer has in his hand right now is a put option. The seller has the right, but not the obligation, to sell an asset. I know what you're thinking right now. Isn't it wildly unfair that just the seller gets to make the decision? Doesn't the farmer have a massive advantage in this transaction now? Why does he get this special kind of treatment? Well, this special treatment comes at a price, the so-called premium, and it has to be paid up front, on the day the contract is signed. So if the farmer and the baker go on and make a put options contract, but the farmer wants the possibility to back out if he's not feeling the contract anymore, on the day the contract is signed, he has to pay the premium to the baker, which is usually a small percentage of the strike price. So in this case, for the whole deal, the strike price is $25,000. The premium would maybe be $500. Premiums always vary, and how option premiums are priced is a whole other world that we can't get into right now. But the important thing is that it's a relatively small amount compared to the full value of the wheat. So now, if the farmer at the end of the 3 months realizes he doesn't want to sell his 5,000 wheat bushels for $25,000, he can just walk away from the options contract, and the only thing he loses is the $500. Now, in this case, the seller had the right to decide whether he wanted to go through with the contract or walk away. That is why it's called a put option. But there's another type of option, a call option. With call options, the buyer, which in this case is our baker, gets the escape door. And at maturity, he can choose whether or not to buy the wheat at the agreed price, and the farmer gets paid the premium for that flexibility. So whether it's a put or a call, an option always works the same way. One side pays a premium for the right to buy or sell at a fixed price later, or to just walk away. If the option holder decides to walk away, they only lose the premium. That's the maximum amount of money they can lose, no matter what happens to the underlying. And from an individual perspective, this is incredibly attractive. You can take on very large bets on prices moving up or down, while risking only a relatively small amount of money. Your losses are capped. But when this logic scales up to the entire market, it becomes dangerous. Limited downsides for many traders means concentrated risk elsewhere. And that's how small shocks that can be triggered by something entirely different turn into systemic crises. We'll talk more about systemic crises in the next videos of this financialization video series I'm doing. So if you want to hear more about systemic risk, make sure you subscribe so you don't miss the next videos, which I promise will be less lectury than this one. But I thought it would be important to explain the concept of derivatives clearly. Also, one last thing about options. Options can be traded on exchanges, but many large customized options are traded privately over the counter, especially between banks and institutional investors. But now, on to the last derivatives we're looking at today. A derivative that was responsible for one of the biggest financial collapses in history: swaps. In the case of the 2008 financial crisis, more specifically, credit default swaps, which were sold as insurance on mortgage-backed securities and on CDOs, collateralized debt obligations, which were built by repackaging those mortgage-backed securities. Let me know if you want a more detailed video about the 2008 financial crisis in the comments, because it's honestly my favorite thing to talk about. But anyways, back to swaps. Swaps are derivatives too. But unlike futures and options, they're usually not traded on exchanges. They're private contracts, negotiated directly between large institutions, completely over the counter. And because swaps are private and traded over the counter, there's no central exchange keeping track of who owes what to whom. Each swap is a bilateral deal. One institution promises to pay, another institution trusts that promise. And as long as everything is fine, that trust never gets tested. Swaps can be fairly complex. They require a deeper understanding of how markets work. The swap market isn't a market that's meant for the average investor. But that doesn't mean the swap market is illiquid or lacks enthusiasm. In fact, the opposite is true. It is one of the largest and most liquid markets in the world, and there are plenty of knowledgeable traders taking part as either buyers or sellers. I want to pause the video really quick and talk about the people who actually make videos like these possible. My patrons. These videos take a lot more work than they probably look like. The research alone takes weeks. Then there's scripting, filming, editing, making all those little drawings by hand, and also filming them, which is the most annoying task, to be honest. It's honestly a lot more work than all the jobs I've ever had in my life, and I barely even sleep. But also, this is my absolute dream job. I absolutely love spending my days making videos for you. And because this channel is still quite small and ad revenue is quite unpredictable, having people support me on Patreon is what actually makes this life sustainable. The Patreon money really helps cover my basic necessities like food and rent. So the people who support me on there really help me to worry a little less about how the next video is going to perform. Because to be honest, the YouTube algorithm is kind of unpredictable, and on some videos I make enough money, but then there can be months where I barely make money through YouTube AdSense. So if you enjoy this kind of deep dive content and want more of it, supporting me on Patreon genuinely helps so much, and it will mean the world if you even considered it. Even small contributions make a huge difference. Also, I host a book club on Patreon where we read the books together that I use for my videos and have bi-weekly meetings to discuss them. Anyways, if you want to be part of keeping this channel going, the link is in the description. And to everyone who already supports me, thank you so much. I truly couldn't do this without you. Alright, let's get back to the video. How do swaps actually work? At their core, a swap is just an agreement between two parties to exchange cash flows over time. No physical goods, no buying or selling an asset, just a promise. One party agrees to make payments based on one outcome, and the other party agrees to payments based on another. Let's make that more concrete with an example. Credit default swaps. And to be clear, credit default swaps are just one type of swap, and not even the most common one, but they're the type that mattered most for the 2008 financial crisis. So I figured explaining them in this video will have a way higher narrative payoff than just telling you about plain vanilla interest rate swaps or currency swaps, which are way more common. But essentially, all swaps have the same mechanics. One party agrees to make payments on an outcome, the other party agrees to make payments on another. Mapped on the credit default swaps of the 2008 financial crisis, that means one outcome is that nothing bad happens. The mortgages keep getting paid. No credit is defaulted, hence the name credit default swap. The other outcome, however, is that credits do fail. Homeowners stop paying their mortgages, mortgage-backed securities collapse, and the collateralized debt obligations built on top of them fall apart. So structurally, credit default swaps work like insurance. In this case, the party basically buying protection via credit default swaps pays regular premiums month after month, and as long as nothing goes wrong, nothing else happens. If things, however, do go wrong, the other side has to pay out a very large amount of money all at once, like insurance. The crucial difference to insurance is this: you don't have to own mortgage bonds to buy a credit default swap on the mortgage bonds. In 2008, one of the biggest sellers of this protection was American International Group, AIG, which sold credit default swaps to major banks like Goldman Sachs, Societe Generale, and others. And as long as the housing market kept rising, selling credit default swaps looked like free money for AIG. Premiums kept coming in, defaults were rare, nothing seemed to go wrong. But the risk never disappeared, it just accumulated. Because unlike real insurance, there was no limit to how many credit default swaps could be written on the same underlying mortgages. The same loans could have dozens of credit default swap contracts written on them, multiplying the exposure far beyond the size of the actual housing market. So when mortgage defaults finally started rising because homeowners couldn't afford their mortgages anymore, the logic of the swap flipped. Sellers of credit default swaps went from receiving small regular payments to owing massive payouts. And AIG, which had promised to pay if things went wrong, simply didn't have the cash to honor those promises. And because so many big banks depended on AIG's ability to honor those swap contracts, the failure of AIG threatened to cascade through the entire financial system. That is why the US government stepped in and bailed AIG out to the tune of $182 billion of public money. About $70 billion came directly from taxpayer-funded programs, and the rest came from emergency central bank support, which sounds less bad than taxpayer money. But ultimately, this is still publicly created money deployed by a public authority to absorb private losses. So it's the public sector, not private markets, who absorb the risk for all of that. AIG then used that money to pay Goldman Sachs and the other big investment banks. So when we hear banks were rescued after the 2008 crisis, it did not mean that the government wrote Goldman Sachs a bailout check directly. But it did mean AIG was kept alive for long enough to pay its credit default swaps obligations. Those payments went to banks like Goldman, Societe Generale, Deutsche Bank, and so on. So the AIG bailout prevented losses from hitting major banks, effectively stabilizing the financial system by honoring private swaps contracts that would otherwise have failed. And as you all probably know, Goldman and the other banks then used that money to continue business as usual, including paying themselves massive bonuses. So the real lesson of 2008 isn't about mortgages and banks. It's about what happens when complicated financial products, originally designed for hedging and risk mitigation, are repurposed as massive leverage, scaled up, largely unchecked, and increasingly disconnected from the real-world economy. Finance becomes more abstract, more layered, and more detached from anything physical. And I haven't even talked about it in this video, but there are also derivatives on derivatives, like CDO squared or options written on other derivatives. Contracts build on top of contracts on top of contracts. It's abstract to a point that feels almost unreal. And these things, even though they are so fundamental to our economy, aren't taught in schools, which is why you just had to sit through a really long YouTube video to understand them. And honestly, props if you've made it this far. But as these abstractions of our financial system are evolving more and more, it ends up having very real consequences. At the bottom of the system, you still have real things. People who lose their jobs, their home, and whose lives get reshaped by decisions they had nothing to do with. Derivatives don't make the economy evil, but they do make it fragile. And under the policy of the last decades, risk has been systematically pushed downward onto ordinary people when things go wrong. Profits stay private, losses get socialized. And once you understand that, a lot of so-called glitches in our economic system stop looking random and start looking like structural issues. In the next videos, we're going to zoom out even further. We're going to look at how money is actually created by banks. We're going to look at fractional reserve lending. And I know the term sounds scary, but I swear it's just made up by finance bros to scare ordinary people away from actually understanding the economy so they can continue profiting off everyone else. We're going to look at how financialization shows up in your everyday life, from student debt and credit cards to retail investing, and how people are pushed to turn themselves into mini investment firms, as well as how things like stock buybacks really work. So if you want to understand how all of this connects, or why the financial crises keep repeating, make sure to subscribe. Anyways, thanks for watching. Bye!